When we think about WACC, it will be dependent upon how much debt a company has versus how much equity a company has. Because debt and equity have different expected returns and different tax implications, we need to think about these two components separately. When comparing companies, it is important to understand that companies with the same or similar WACCs will be deemed to be equally as risky and require the same return from investors. Since we think about the debt and equity components separately, we'll look at their formulas separately. The formula for the weighted average cost of debt will be the cost of debt times the amount of debt a company has divided by the sum of the debt and equity, also called the value, times 1 minus the tax rate. Because debt is tax deductible, this will reduce the overall cost of debt for a company and is important to ensure that we account for in the equation. The cost of equity has a similar formula. However, given that equity is not tax deductible, we will not have this as a component in the equation. So the weighted average cost of equity will be the cost of equity times the amount of equity divided by value, or debt plus equity. Please keep in mind here that when we are looking at the cost of debt versus the cost of equity, the cost of debt will always be lower because it sits higher in the capital structure, meaning that in the event of a default or bankruptcy, debt holders will be paid back first, reducing their risk when compared to equity holders. Because of this reduced risk, the cost of debt or expected return on debt will be lower than that of equity.